Welcome to Market Focus. Today we're taking a closer look at how the tariff trade wars are affecting the markets from stocks and commodities to currencies, and, well, everything in between. If you're new here, we discuss trading, investing, and global market trends that can shape your financial decisions. Today's topic, trade wars and tariffs, and how they've impacted various markets. As always, this video is for educational purposes only. Do your own research or consult a professional for personalized advice. Let's dive in. A trade war typically starts when one country imposes tariffs, essentially taxes on imported goods, on another. The targeted country often responds with its own tariffs, creating a cycle of escalating barriers to trade. Key points include tariffs increasing prices, and imported goods become more expensive, potentially raising costs for businesses and consumers. Retaliation. Affected countries retaliate with their own tariffs, impacting global supply chains. Market sentiment. Trade disputes add uncertainty to international markets, often triggering volatility in stocks, commodities, and currencies. Why it matters. Global trade has deep interconnections. Higher tariffs can slow down economic growth by making goods more expensive and reducing international demand. To understand the market impact, let's look at some recent historical examples of trade wars and the main participants. US-China trade war timeline. Starting around 2018, the US imposed tariffs on billions of dollars worth of Chinese imports. China retaliated in kind, affected industries tech, agriculture, manufacturing. Market reaction episodes of high volatility in both US and Chinese markets, with global supply chains disrupted. Other instances, Brexit could be considered a trade-related event, reshaping tariffs and trade agreements within Europe and beyond. Steel and aluminum tariffs by the US also led to retaliations from multiple trading partners. These trade tensions often spill over into global markets, creating opportunities and risks for investors and traders. When trade wars heat up, stock markets often feel the effects first, so let's break it down a bit. Tech and manufacturing stocks, especially those companies that rely heavily on Chinese manufacturing or global supply chains, they might see their costs go up, which in turn can hurt their profit margins. Now, when it comes to consumer goods, if tariffs make imported products more expensive, that can either lower demand or, squeeze company profits even further. And then there's market volatility, the uncertainty about whether tariffs will escalate or not. That can lead to some pretty wild swings in equity indices like the S&P 500, the DAX, and the Nikkei. Case in point, during the US-China trade standoff, tech giants and semiconductor stocks saw sharp intraday moves every time there was an announcement of new or reciprocal tariffs. It was honestly a roller coaster. Alright, so next let's talk about commodities and currencies, two markets that, honestly, can experience some pretty significant fallout during trade wars. When it comes to commodities, let's start with agricultural products like soybeans, corn, and wheat. Retaliatory tariffs on US farm goods can lead to an oversupply in domestic markets, which usually means falling prices. Now, for metals like steel and aluminum, tariffs tend to drive up domestic prices. But there's a catch. They also reduce export competitiveness if other countries respond with counter tariffs. Moving on to currencies. In times of uncertainty, investors often flock to what we call safe haven currencies, like the Japanese yen or the Swiss franc. That demand can actually strengthen those currencies. On the flip side, emerging market currencies, especially in countries that rely heavily on exports, can weaken if a major trading partner slaps on tariffs. And don't forget about the US dollar. It's kind of tricky. It can be seen as a safe haven, sure, but it can also come under pressure if trade tensions start hurting the US economy. This whole interplay means that Forex and commodity traders really have to keep a close eye on any tariff announcements, since they can move these markets fast. So, how will tariffs and trade disputes continue to shape the markets going forward? Well, let's break it down. First, there's always the possibility of negotiations. Countries might seek new trade deals or even compromise on tariffs. And when that happens, we often see a boost in market sentiment, especially if there's a breakthrough. Then there's supply chain diversification. Companies may decide to shift production to different countries to avoid tariffs, which could actually give a lift to certain emerging markets. Now, for traders, volatility strategies come into play. A lot of them use options or futures to hedge against short-term swings that can come from unexpected tariff announcements. And for long-term investors, they might focus on companies with strong domestic markets or well-diversified supply chains, the kind that can weather all this trade uncertainty. In a world where trade disputes can flare up with little warning, staying informed about global policy changes is absolutely key to navigating market volatility. And that pretty much wraps up our look at how tariff trade wars affect the markets. From stock volatility to shifting currency values, trade disputes really can have some far-reaching consequences. If you found this video helpful, please go ahead and hit that like button and subscribe for more insights on global markets. Also, I'd love to hear from you. Drop a comment and let me know your thoughts on the current trade environment. Do you think we'll see more tensions ahead? Or are you expecting some resolutions? As always, trade safe, and I'll catch you in the next video. Thanks for watching, and hey, don't forget to subscribe and ring the notification bell so you never miss an update.